Is buying a house actually one of the worst financial decisions you can make compared to the stock market? Let's find out. For decades, people said buy a home, but when you stack the numbers, the stock market often tells a different story. We'll run the math, show real data, and give a verdict that might change how you invest forever. Stocks generate wealth through two main channels: price appreciation and dividends. Price appreciation is simply the increase in a stock's value over time. Dividends are regular payments made by a company to its shareholders, which can be reinvested to buy more shares, creating a powerful compounding effect. Historically, the S&P 500, a benchmark for the US stock market, has averaged about 10 to 10.5% in annual returns over many decades. This isn't just a number, it's a testament to the power of American innovation and economic growth. Thanks to the magic of compounding, that consistent growth can add up to life-changing wealth over an investor's lifetime. Real estate, on the other hand, pays you in two distinct ways: price appreciation and rental income. Historically, US home prices have appreciated around 4 to 5% annually. This rate is significantly lower than the stock market's historical average. So, if we look at appreciation alone, the story seems pretty one-sided. That same $10,000 invested in a house that appreciates at a 4.5% annual rate for 30 years would only grow to about $37,500. It's a respectable gain, but it pales in comparison to the stock market's performance. But this is where the comparison gets more interesting. Real estate isn't just about appreciation. The addition of rental income and the strategic use of leverage make the story far more complex and compelling for many investors. These two factors can dramatically alter the financial outcome of a property investment. Rental income is the X factor that can turn an average real estate investment into a great one. This is the cash flow generated from tenants paying rent each month. Average gross rental yields in the United States typically fall between 6% and 9%, though this figure varies widely depending on the specific location, property type, and local market conditions. In some areas, rental yields can be much higher, while in others, they might be lower. This income stream provides a regular, predictable source of cash that can cover the property's expenses, such as the mortgage, taxes, and insurance, with the remainder becoming profit for the owner. This cash flow can significantly boost the total return of a real estate investment, especially in markets where rents are strong relative to property prices, turning a tangible asset into a cash-generating machine. Leverage is often described as real estate's superpower. It's the ability to use borrowed money, typically a mortgage, to control a large asset with a relatively small amount of your own capital. For example, a 20% down payment on a $500,000 property means you control the entire asset with just $100,000 of your own money. If the property's value increases by just 5% in 1 year, that's a $25,000 gain. Relative to your initial $100,000 investment, that's a 25% return, not just 5%. This amplification of returns is incredibly powerful. However, it's crucial to remember that leverage is a double-edged sword. It works both ways. It amplifies gains, but it also magnifies losses. If the property's value were to fall by 5%, your equity would take a 25% hit. It's essential to factor in all the associated costs, like mortgage interest, property taxes, insurance, and potential vacancies, before assuming that leverage guarantees big profits. Beyond the mortgage, real estate comes with a long list of hidden costs that can eat into your profits. This is often referred to as friction. When you buy or sell a property, you face significant closing fees and real estate agent commissions, which can total thousands of dollars. As an owner, you are responsible for ongoing expenses like property taxes, homeowner's insurance, and, of course, maintenance and repairs. A new roof, a broken water heater, or a plumbing emergency can result in sudden, substantial costs. If you choose not to manage the property yourself, you'll also have to pay a property management company. These expenses collectively reduce your net return, making the true profitability of a rental property lower than the gross rental yield might suggest. Stocks, in stark contrast, are remarkably low cost and liquid. You can buy or sell them within seconds with minimal fees, and there are no surprise repair bills or property taxes to pay. This simplicity and ease of management make stocks an attractive choice for many investors. Timing matters immensely in both markets. If you buy stocks or real estate at the peak of a bubble when prices are highly inflated, your future returns can be severely disappointing for years to come. Market sentiment can drive prices far above their fundamental value, creating a significant risk for late-stage investors. Many financial analysts emphasize that starting valuations play a critical role in determining future returns. Buying a great asset at a terrible price can lead to a poor investment outcome. This is why focusing on long-term averages and fundamentals is far more important than getting caught up in short-term hype or trying to time the market perfectly. Whether you're investing in a company or a property, understanding its intrinsic value and buying at a reasonable price is key to long-term success. So, who wins the battle for your investment dollars? When it comes to pure price appreciation, stocks have a clear historical advantage, with average annual returns of around 10% versus real estate's 4 to 5%. However, the picture changes when you factor in rental income and leverage. These elements can make real estate a highly competitive investment, and in certain markets or scenarios, it can even outperform stocks. The catch is that real estate demands active management, involves higher upfront and ongoing costs, and carries concentration risk, as your capital is tied up in a liquid asset. Stocks, on the other hand, offer a simpler, more liquid, and historically faster path to compounding wealth for the passive investor. The S&P 500 represents a diversified portfolio of hundreds of top companies, reducing the risk associated with a single investment. Ultimately, the right choice depends on your financial goals, risk tolerance, and how actively you want to be involved in your investments. If you are looking for passive, diversified growth over the long term and value liquidity, stocks are usually the better option. The ability to invest small amounts, diversify easily across the globe, and let your money compound with minimal effort is a powerful combination. However, if you desire a tangible asset that generates regular cash flow, are comfortable using debt as a tool, and don't mind the hands-on work of being a landlord, real estate offers unique advantages. Many of the world's wealthiest investors don't choose one over the other, they choose both. They use stocks for long-term, compounding growth and real estate for steady income, diversification, and as an inflation hedge. This balanced approach allows them to benefit from the distinct strengths of each asset class. So, is buying a house the worst decision? Not always, but don't assume real estate beats stocks. The data shows stocks historically compound faster, while real estate shines with cash flow and leverage. Which side are you on? Tell me in the comments, and don't forget to subscribe for more investing breakdowns.